Hello class, this is Dr. Fenton. In this video, I would like to cover the concept of present value. Present value is used in Chapter 13 with some of the capital budgeting decisions, but more importantly, present value is used extensively in the financial world. What we're trying to do in the present value computations is bring future dollars out there at different time periods and different interest rates that you're assuming, all back to the current value of today's money. That's called the present value. So, $1 in the future, so many periods out there into the future, at a certain interest rate or discount rate, what is that worth in today's money, today's currency? What's the present value of that amount in the future? That depends on two factors, and you see both of them in the table here. Depends on the number of periods you're dealing with out into the future and the interest rate or discount rate you're dealing with. Now I've highlighted 10% and 10 periods just to give you an example. So let's say that you have a savings account that'll earn 10% every year. We all would love to have that in a savings account. It's quite high. But let's say you did find one that earns 10%. If you would like to have $1 10 years from now in that account, that's the future value. So that $1 in the future, 10 years from now, at a discount rate or interest rate of 10%, what is that worth in today's money? And another way to say it is, how much would you have to put in the savings account today where you could earn 10% compounded annually for 10 years and have $1 at the end of that 10-year period? How much would you put in that account today? If you go down the 10% column, across the 10 period row, you come up with 0.386. Now this is like 38.6 cents. So this is saying if you could put in 38.6 cents in a savings account today, and again, it earns 10% compounded annually, and you don't touch it for 10 years, then at the end of the 10-year period, you will have $1 there. So you will more than double your money. So that's just $1. If you put in $1,000, $10,000, you'd have quite a bit of money in that account. So what you're doing, you know the amount in the future. You're trying to bring that back to today's money, the present value. And again, you need two factors to do this: the number of periods out there in the future and the interest rate, or sometimes called the discount rate, that you're using. That's the present value of a dollar table. Like it says here, present value of a dollar table. There's the formula if you want it. I'm not going to worry about it. Let's look at the next table. This is the present value of an annuity of $1 in arrears. What this means is you're not dealing with just $1 at one time in the future. You're dealing with equal amounts every period. So you're looking at $1 per year for, in my example here, 10 years. So again, you're asking the question, how much would I have to put in a savings account today where I can earn 10%? And then at the end of every year, I will take out $1 from that account. So over the 10-year period, you will take out $10. So how much do you have to put in the account today to be able to do that? Again, go down the 10% column, across the 10 period row, and you have 6.145. So what this means is that if you put in $6 and 14.5 cents, if you could do that, so $6 and 14.5 cents in the account today, and that account earns 10% compounded annually, then at the end of every period, period 1, 2, 3, all the way up to 10, you could pull $1 out of that account. So your total amount you pull out is $1. But what's the present value of all those future dollars in the future? $1 a year for 10 periods. The total present value is $6 and 14.5 cents today. So we all know that $1 in the future is not worth as much as $1 today. And that's what these present value tables show you. The reason it's not worth as much today is because, like inflation, prices go up. So you can buy more with $1 today than you could in 10 years from now. So going back up to the first table, what is that $1 10 years in the future, discounted at 10%? What is it worth today? It's worth 38.6 cents. So that's a quick overview of the present value tables. We are going to use these tables with the net present value computations in Chapter 13 that deals with capital budgeting decisions.